Like, why am I here?
I don't know. Why are you?
Well, from a CFO standpoint, you work very closely with people like me, right? Because we bring strategies that the CFO can help implement for the owners of companies.
Yep.
And these strategies are rather sometimes unique and specialized for the circumstance of every single company. And it really helps when we have a great CFO to work with who gets it, who understands that when we're talking about moving assets from column A to column B to get a deduction, deferral, or exemption, why that's important and how that benefits the client, so that the client who may or may not know what questions to ask, the CFO can translate all of this stuff and help it make sense.
Basically, the CFO should be the gatekeeper, is how I kind of look at it, to generational wealth. And so wealth management is a very big part of that, because if we're doing our job right, one, we've mitigated risk. Two, we've ensured that the company is so profitable that they're able to grow exponentially. And then three, they're able to withdraw themselves from the business. And so once you get to a point where you've got the business owner out of the business and they're making large amounts of cash, what are they going to do with it next? Well, it's really simple. We've already got Jake and other people in place to be able to increase wealth. And then we should be looking at things like their total net worth at that point, rather than just looking at the business. Because at that point, they're starting to look for people that can show them what their net worth is, help them budget on a personal level, and how much money should we even put into investments so that you can take that type of money, not just from a tax planning perspective, but from an overall wealth generation. And then we get into real estate and all this other stuff.
Absolutely. Absolutely correct. Now, there's a lot of pitfalls that people run into, Aaron, in advice that, I don't know, you talk about profit first.
Yep.
But do you see some common mistakes? We talk with a lot of CPAs. We give a lot of presentations to CPAs, sometimes presentations that are eligible for CPE credit, sometimes not, whatever, right? Mm-hmm. But there's a lot of traditional tax planning strategies that really just don't make a whole lot of sense from a net worth and a profit first perspective. I think the best advice I heard from one CPA to a client is they said, hey, my last guy told me to go buy a car. It has to be over 6,000 pounds. And well, I just don't really need a car. And so the CPA said, well, don't buy it then. If you don't need it, why buy it?
None.
Anyway, can you go into that a little bit and kind of help us understand? I guess you talk to business owners every single day. You compare their financials this month with financials from last month. You do a lot of different things to help them understand where they're at financially and where their trajectory is taking them, right? Can you maybe talk about some of the most common pitfalls that they run into?
We don't want to be running more payroll. I have a client right now, their previous CPA was like, and they're a C Corp, and I guess it worked back in the day, ran $1 million through payroll. How is that going to benefit anyone when I think it was 45% of that money was taken before it even hit his bank account?
So $1 million through payroll.
Mm-hmm.
And there's a lot of people out there that we might want to emulate for one thing or another. And I'm not talking about their personalities, but maybe their business model or something of that nature. So Steve Bezos, or Jeff Bezos, I'm sorry.
Yep.
Steve Jobs, Jeff Bezos, Mark Zuckerberg, Bill Gates, like a lot of these people. What do they have a lot in common in regards to their salary, Aaron? What do they pay themselves?
Low as possible. We don't want to be paying ourselves that way. Like, we can take loans against assets where if you have a high salary, it's just going to get taxed out the wazoo by every single entity, whether it's state or federal.
So, Aaron, this is something that bewilders a lot of business owners because they've worked all their life so that they can get paid more. What they're missing is that they try to do it through payroll. As you mentioned, that's very much a common thing among business owners, is to continually increase their payroll because they can afford it. Yep. When at the end of the day, a lot of these people that we want to emulate have a payroll, an annual salary of $1.
Yeah, where possible.
And so kind of interesting that their road to success is leading them in a less efficient tax trajectory, right?
Mm-hmm. And a lot of CPAs do that. Like, we want to put assets in place with a lot of our people, so then we can take that asset and get a loan against it, and it should appreciate at a higher level. And so then what the interest rate is, so then they can live on that money, and then we're using the asset to pay that back. That's how I've always structured it on this side of things. As we grow their assets, we're able to take those loans and do other interesting things with that money, rather than just pay taxes on it. Some people like to pay taxes, and I was talking to someone like that yesterday, and I don't necessarily agree with him, but hey, if he wants to do that, that's fine.
Now, let's go to the basics. I want to touch on a bunch of these common pitfalls and mistakes that you've got. But Aaron, let's jump way back because we just had several listeners jump in and join us right now. Essentially, from a profit first mentality, or from what I call tax advantage wealth management, what we're trying to do is these business owners, a lot of them are actually very successful. Mm-hmm. The sad thing is, even though they're very successful and they're making more money, some of them are not taking home more money. And a lot of it has to do with the tax rates and the brackets that people find themselves in, and just making unwise financial movements of money.
Yep.
So we try to implement various strategies at my firm to help individuals move assets from column A to column B. Column A is like their bread and butter business. It's their cash cow, right? Yep. And we're trying to build additional assets so that over time, their overall net worth is increasing, even though their tax rates are also increasing.
Yes.
And oftentimes, there are strategies that are lesser known that a lot of people are not familiar with for whatever reason. But everything that those Fortune 500 companies do, I would say 80% of those strategies, your common, everyday, modern American business owner can also be doing and taking advantage of if they just knew about them. And a lot of times, all it is how do I move money from column A to column B, build up an asset in column B that then feeds into column C, and we're getting deductions, deferrals, and exemptions all the way through. And we're using money that we'd otherwise pay taxes with to build new assets and increase your overall net worth.
And you've got to think about it. If the business is the only thing that's generating them income, as a CFO, one of the biggest things that we do is try and help mitigate risk, mitigating all types of different risks within business. But if you only have one asset that's the business, if something happens in the economy and something happens anywhere, or you get some negative press, you go get canceled or something like that happens, what else do you have? You have nothing. And so we need to start looking at business owners a little bit differently and start diversifying as much as possible and get cash generating assets to help diversify into different areas. We had one business owner, they did really, really well for a really long time. And then they ended up starting to drop out over the last, say, 2 years. And they didn't build up their wealth at that time. And they're like, well, Aaron, I wish I met you earlier. And it's because we're now starting to push them to generate wealth, even with the business not doing as well as it traditionally did. We were able to use profit first, which is basically us just forcing a level of profitability so they can take that cash and diversify that risk.
Absolutely. Well, let's get a little bit more specific. Sure. We've got an audience. We already have questions coming in. And this is kind of fun and exciting, right? Because we get to answer people's questions. But we're going to put the questions off for about another 10 to 15 minutes while Aaron touches a little bit on some of these other common pitfalls. So we touched on the first one, which was, Aaron?
Risk about having just the one business.
Risk about having just the one business. And we touched on a second one earlier on. Some of you missed this one. And it was how business owners, in an effort to get paid more, they're just doing it through payroll, which is perhaps the most inefficient method of paying yourself as a business owner.
Yeah. Let's set that reasonable compensation as low as possible.
Very good. Now, there's a lot of different strategies behind doing that. And sometimes it has combative ramifications with other tax saving strategies that are more traditional in thought and theory, like qualified retirement plans and things of that nature. But
yeah, like SEPs and those 401ks where possible, because you have a finite amount of money that you can put into it.
So you have to weigh the pros and cons of where you want your reasonable comp to be. If you want it to be as low as possible in the 30s, 40s, 60s, thousands, whatever, right? Or up to 200,000, 235,000. But they're really, anything below there is fine and adequate. But why on earth would I pay myself $1 million to payroll if I'm the business owner, when there are so many different ways to pay myself through a company that are a lot more tax efficient? Mm-hmm. Anyway, we don't have time to touch on all of those this moment, but let's jump on to another pitfall. Aaron, what would be number 3 on your infamous list of business pitfalls?
So having the business owner as the primary person in the business, like driving all revenues and being completely dependent on said business owner, because we need to start looking at it from CFO perspective of, hey, how much money do we need to generate and spend to get the business owner out of the day-to-day? because there's a very large risk there between that. And then I'll go on to the next one after that is employee dependency. And that is the second, that would be the fourth one that I'm looking at is employee dependence or other shareholders. Because if something happens there, then we have a very big hole in the company, and can it survive when those types of things are coming? So what are the things that we're doing when we're forecasting and looking at the future for said company to extract the business owner from the day-to-day while still making it tax advantageous? So they're not taking 500K in salary because the business is doing well, and then being able to still increase that net worth. So we should be looking at all these different areas within the company and taking into consideration like a timeline, because the next thing after that is each owner is either looking to either sell the business because it's their nest egg, or they're looking to have the business run itself. Every business owner I know is, hey, I want this thing to run itself, or I want to be able to sell it later, to make it so that you can sell it for a massive multiple. And I'm talking like 4 to 6x. You need to not have the owner being part of the mix. You need to make sure that there's no key employees that are going to, if they leave, ruin the business. And then you've got other interesting factors within that realm.
So Aaron, it's rather apparent that you help a lot of business owners scale, specifically from that last point that you made, in the sense that how can you sell a business if it's solely dependent upon the owner?
Yep.
And if you're trying to sell the business, get rid of the owner or get the owner to retire, what have you, there's really nothing to sell unless the owner goes with. So you have to replace the owner in the business. But then you also talked about a couple other things: employee dependency as a risk and shareholder dependency.
Yep.
So how do you combat that risk? Because we talk about how we have to be able to replace the owner, but then there's shareholder dependency and there's employee dependency. What is it that you do for people as the CFO to help them mitigate those three risks?
So as we're scaling, because the very first thing is making sure, one, they've got marketing all dialed in. We need a marketing spend. We need to make sure that there's profitability there. And what that looks like in each company, 3 to 5x return on ad spend, or a revenue generating system. If they're over $1 million or even over 5 million, they've got some system that works. So we know we've got a scalable system. The next piece is making sure, okay, well, what is our budget for the company? And I use profit first because it's simple for business owners. They can look at their bank account and they can move the money to the buckets. Okay, so now we've forced profitability. The next piece then becomes, okay, how many people do we need to get each employee out of a driver seat? So right now we have one person that we're working with. They're a $15 million company. She runs everything, but she's only got 11 employees. If we use the model that the Fortune 500 companies use, they use one employee per $300,000 to $400,000. If we use that model, she should potentially have 30-ish employees. So what we're looking to do is start bringing in more staff to sort of circumnavigate the employee dependency. So, hey, we've got one person that can do this, only this one thing. Okay, well, how do we get 2 others that can then do what that person does and they can manage them? And then we start getting the necessary support staff there to spread that risk out across the whole company. And then we start working on the owner, because we want to get rid of the employee risk and then start on the owner. And then we start to slowly extract it because we've already got management in place. We've already got golden handcuffs in place. And then we're slowly going to extract that business owner so that they can focus on other wealth generating things. Like, I like real estate. So it's just, it's a step at a time. And normally, like, it took me 3 years to get one of my higher net worth individuals fully out of the business. Now he takes $600,000 to $700,000 out of the company, and we help him do that. And then we're starting to go down the real estate route now because he likes real estate. We can get cash flow without necessarily having to pay taxes.
So if you have an employee who's so critical to the outcome of the company, and there's no golden handcuffs and there's no competition for that employee, that can become a threat to the company if they leave or take over or hold the owner hostage, so to speak. I mean, these are dire things that we sometimes talk about. But that's also kind of why I hear in these presentations sometimes that you hire in threes, or based on profit first, you scale trying to get to that 3-person number, right?
Yep.
And at a minimum, because, 2 is competition, and that's good. Between 3, it's more of a collaborative, friendly, and and the employees understand that they're, and this sounds almost bad sometimes, but they understand that they're replaceable, right? That the company won't die if they decide to go to the competition, and that the company will continue to move on. So that's all about a business continuity plan, being able to remove the owner, have a number of specialists and staff members that can help it continue to move towards the future so that it can, one, be sold, or should something detrimental actually happen to the owner, the business can still move on.
Yes, we had a person that they had an employee that basically had them over a barrel, so to speak. And what we ended up having to do is make those extra hires, get those people to start taking over more of that person's role, and then renegotiate the contracts, because they were taking something like 25% of revenue out of the company. And we weren't talking about ad spend. It was before ad spend. It was just top line revenue. And so they had none of the risk, and they were taking large portions of the cash out of the back of the business. So we had to put these people in place extremely quickly, make that person redundant, and then we could start having negotiations about what it looks like going forward. But then it puts the business owner in a position of power and of strength when we come into said negotiations, rather than letting the key employee dictate what's happening.
Right. Well, very good. Now, let's talk about some of those golden handcuffs. What's an efficient way to offer those, Aaron? I mean, what do some of your clients do to begin with? And then when they get enough profit, what do they end up transitioning to later?
So I use one that I like the most, because a lot of people are going to talk equity, and I do a lot of equity deals, and there's a lot of tax ramifications with equity deals where the person that you want to give equity to, say if the company's valued, I don't know, $12 million and they want 5%, well, you're probably going to have a tax bill of like $360K, just rough numbers. So, and the employee isn't going to necessarily be able to pay that. So either the company's going to have to, or they're going to have to do a loan, or they're going to have to do something like that. So what we generally structure is we take 5 or 10% of revenue and we put it into an account every single month, and say they want 5%. So we'll put 5% away. And what we do is we make it so they cannot access that money until year 3. At the end of year 3, they get year 1's money, like cash. So it could be $100,000, it could be $500,000, depending on what the companies do, like how well the company's doing, because these are key employees. We want them locked in for 3 years, at least 3 years, if not more. So then year 2, well, that goes up even higher. Year 3, it goes up even higher. At the end of year 3, they get year 1's cash, and so then year 2, and so on.
Yeah. So this could be as easy as a sinking fund, or as complicated as an executive bonus plan, or any number of other types of company corporate benefits that you can discriminate with, where it's designed for those individuals that help you perform, and they have to vest. You mentioned at the end of 3 years, they have no access to it until then. And that's very helpful, because they can see this account growing, whether it's in life insurance, or whether it's in a sinking fund, or whether it's in any other type of benefit, right? There's a lot of strategies here we could go over, but they see it growing and they don't have access to it until they perform, until they stick around, until they grow with the company. That's a great definition of golden handcuffs.
Yeah, and then if they don't perform and they don't continue to provide value, and they leave, well, there's nothing there for them, and they don't get that cash. So it encourages them to perform. It keeps them there longer. And then in year 5 or 6, if they're like, hey, I want to leave, hey, you've got XYZ amount of money sitting in the bank earmarked for you. Do you really want to leave? And so then it gives you a little bit more for them to be able to bite into, and you can raise or lower that. I would recommend raising as they provide more value without having to worry about ownership or equity. And then if you sell later down the track, 10 years later, they're still with the company, and you sell for a massive multiple, all the cash in the bank for them goes to them, and you don't have to give them a piece of the pie, because it makes it so much more difficult when you have more shareholders in that pie and asking questions and then wanting to understand and then trying to pour over different financials and being like, hey, this is what we need to do, because too many chefs in the kitchen ruin the broth.
Exactly. Well, very good. So here recently, you've had some clients that have been scaling. And they've been getting to a certain level of profitability where some of these higher level strategies really make sense. Yep. I know that you've been able to bring me in on a few clients where we've started to set up a rainy day fund that is actually a deduction for the company under Section 831B. 831 of Title 26, paragraph B. Now, can you help us understand from a cash flow perspective how that helps the client?
So I always like this one because we put 10% away every single month for all of my clients, because the large corporate companies put 10% away on every single month. Like Ford, I believe, was the one that I was researching that did it 10% every month. We're able to take that money and instead of just leaving it in a bank and letting it grow in the bank account where we're not going to get any interest, we're not going to get anything, we can take it and we can put it into 831B where it's going to appreciate. And so I always like that strategy because we've got the money there. We've built it up over the 12 months. We then shift it across to increase wealth, and then it's able to appreciate on the stock market. And we're able to lend against it if the company ever has an issue, or if the owner wants to go out and I'm going to keep coming back to real estate. If they want to go out and get a real estate portfolio and they need $500,000 to go out and do that, and they've got 500 already sitting in the bank, they can lend, put it back into the business, take that 500,000 and go and put it into different asset classes. And then we're using the money twice at that point. So we're able to do a lot with that. And then we're able to show them, hey, this is here if you need it. And we can utilize that money. And I'd prefer it than like life insurance, but because we're able to get access to it and float the business if we have economic injury or something happens with the economy.
Well, it's an asset that's owned by the business where, a lot of times the life insurance oftentimes is like a 10-year plus funding period before you really have the lending power to do something significant. And by the way, if you're going to be funding life insurance, there's a way to use other people's money to fund that life insurance so that your return on investment is significantly greater. However, again, that is typically a 10-year, 7 to 12, depending on age and health and everything else, funding period for it really to make sense. But coming back to this strategy, exactly correct. First and foremost, they have immediate access to the dollar should they actually have a rainy day. Should they have something instant and sudden that affects their income, affects their business, something that they can use this money for, they can access it immediately on a tax favored status. So they got a deduction for putting it here, and they have immediate access should they have a qualifying event. And then after that, there's a recharacterization of tax status, which is phenomenal. This is definitely efficient. You get an immediate, up to 17% federal tax savings just from 1 year to the next by holding it here for a year. Now, most people don't access it like that, though. Most people, they're building this other asset that they have rights to, and they can actually lend from. So they can pull out cash, replace it with a promissory or what have you, but they can pull out money to help their business grow. They can pull out money even for personal things. And it's not income as long as they pull it out for a proper, let's just say you do all the documentation correct to make sure that you're meeting all the regulatory whatever, right? But that's kind of what we help our clients do, is manage the proper utilization of all of their funds in various buckets, and that this rainy day fund that they can put together under Section 831, paragraph B, can be one out of many buckets that they can be creating from their cash cow business. Again, moving assets from column A over to column B. And eventually, because this is money that has been deducted, it can have other utility as well. And then you can use it to build a column C asset, which could be for business continuity, what have you. It could be that life insurance policy on the owner rather than the employees now, right? It could be something between a partnership that seals the partners together. Because we talked about golden handcuffs for employees, but what about partners that are integral for the future outcome of business negotiations because of their contacts, their influence, their background, their history, and how do we keep the partnership together? That could be another method, and it might be something that you want golden handcuffs on for longer than typical 3 to 5 years. And that could be something that could be accomplished through a financing, leveraged life insurance policy that has all its debt paid off within 10 years and a very large, significant buyout built in, which could be more efficient than a seeking fund because you're using other people's money to fund it.
Yep. And the other option is with real estate, well, you can also pay the loan back from a cash flow generating asset, which is why I like to use it, is because we can then do that. We put an interest rate that's comparable to the market because we know that there's going to be a rate of return on the 831B. And so then we kind of mirror that of like, hey, this is what the interest rate should be. So we can take the cash plus the interest and pay back the loan from the asset. If you have enough within the 831B to be able to do that, then you're able to start creating that, they talk about life insurance and be your own bank, but then you are able to actually do these, and the interest expense, well, it's still an expense to the business.
Absolutely.
And so now you're starting to double dip because the interest pays, the company, like the asset pays, and then you've still got the business that's generating more income to be able to put more in. And so that's how I like to think of it when I'm doing it, because then we're able to shuffle the money in a more advantageous way because, all right, we're able to compound the losses with the real estate due to depreciation, interest, and those types of things while still getting cash.
Now, Aaron, let's talk about the trajectory of a client. In your business, you help them scale, you help them build to sell. Now, some of them actually sell. That's typically one of the most costly taxable events of somebody's life, either when they sell a highly appreciated asset, or when they die, depending on their estate. So walk me through the process of helping somebody get ready to sell their business. What is it that you do? Normally
we start looking at the finances, but with a lot of what we do now, we don't have them sell, because what investment gives you more growth than a business? So most of my business owners that we withdraw, they don't end up selling. They continue to take cash from the asset, like from the business, which is now an asset, and they have other people running it so that we can put the money in other areas. But from the, how am I going to put this? The build up to be able to sell, we look at pretty much 6 different things. And those things really are, like, from an investment standpoint, we want to be looking at financials and cash performance, making sure that we've identified all of the risks and gotten rid of all the debt, making sure that the results are predictable. We look at growth performance, like, is your market growing? Is the industry growing? And we start talking to them about recurring revenue models, because most investors want a predictable future stream of revenue. So if you don't have a future predictable stream of revenue and you're having to go out and you're spending on Facebook or Instagram or TikTok or LinkedIn, wherever you're getting clients, well, if you have a recurring revenue model, we know how much money is going to be in the very next month. And then we start looking at things like customer score at that point, because customer score, we're going to have pretty much probably 25% of people that are going to actually respond to a net promoter score. And then we're going to have the people that are just ambivalent, they don't really care too much. And then we have the people that really are going to come in and say, hey, you suck. So we start looking at the customer score, because that's going to be an indicator of future growth. And it's also going to be an indicator of your churn rate. So we start looking at customer score, and then we start looking at hey, how much market control do we have? Do we need to add additional services? Do we have a really good way to differentiate ourselves from the market? And then we start making sure that those are in place. We take stock of relationship dependence and owner dependence. And once we've got that and everything is scoring, and I've got a questionnaire I go through, once they're scoring above an 80, that's when we go to market, because that is when we're going to get a real investor, not just someone coming in from the street and saying, hey, we're going to owner finance this. Because we all know how owner financing goes. Traditionally, the business within 3 years goes bust, because they come in, they take a portion of the money, they'll give you a down payment, and then they'll say, hey, I'll pay you future streams of revenue. And it doesn't really go anywhere. So at this point, we're starting to get to above that 10 million mark, and it makes a lot of sense for a real investor that wants a business that'll run itself to put down a larger multiple. And I've seen them go 6, 8x just because the thing was just throwing off so much cash.
Well, very good. So I guess from that, I'm going to pull out of that people have various different types of exits, and you help them build up their business in such a way that they can continue to own it, continue to get revenue from it, and that they can kind of step out of the business, right?
Yeah.
Let's talk about some of the tax ramifications, though, should they actually sell their highly appreciated asset known as their business, because now they fully want to move into the next game.
Yep.
So maybe they sold sewing machines for a very long time, and they're going to sell that business and go into real estate.
Yep.
What would you make sure that they knew prior to selling that business about the tax ramifications specifically?
we would work out how much money that they're actually going to pay in taxes. And then we have a conversation. What do you want to do with it? The first one is, do you want to just pay the taxes because you want the cash? That's the very first thing. Do you want control of the money is the next question. Because if they want control of the money, it's going to determine different things. Are you okay with not having control and not paying any taxes and then being able to have the money drip fed to you? So once we've identified those three key things, then we can start having conversations around what tax strategies will make sense to be able to do that. Now, we've got, like we will go through you for these, for the deferred sales trusts, where they can have all of the money and they're not going to pay taxes on it until they take the money out. But sometimes we have clients that are just like, Aaron, I'm going to pay the money and then I'm going to take that money and I'm going to go invest it in other areas, real estate, property, like properties, and then, or stock market, whatever makes sense to them. So it just really depends on those three things because each business owner is going to be different.
So I think what I'm going to highlight there is that we need to identify first and foremost prior to the sell, because a lot of times people are way too reactionary. They go and they do a thing because they think it feels good and it's the right time and they can get the right price. But the right sales price doesn't always mean the right net home price, right? And from the profit first mentality, which you are amazing at instilling within your clients, they understand not only from a cash flow perspective, what is profit, what they get to take home, but in large transactions like this, what is their net?
Yep,
now,
that's work out.
Talking to an M&A advisor just the other day, her biggest obstacle in helping individuals not back out from a sell, because a lot of times there's a negotiation. There's the seller wants one price, there's the buyer who wants another price, and oftentimes they meet somewhere in the middle.
Yep.
When one gives up ground and then they realize afterwards how much they're going to have to pay in taxes, a lot of times it changes the entire game.
Yes.
So from before it's even listed for sale, before there's even an M&A advisor, there should be a conversation about adjusted basis. There should be a conversation about sales price. There should be a conversation about state and federal tax ramifications, whether or not you're a service business or if you have a physical hard asset like real estate and you're subject to the additional Obama tax. All of those different things should be taken into respect so that
and making sure that they talk to their advisors before doing the pen on paper is the biggest thing, because we're already in and we have an agreement with all of our clients that we have to be in there and they have to sort of, before they do anything big, consult with us. And so we make sure that we're there every single time and every step of the way, and even help in those negotiations. So we help them in that realm of things. And then we go pretty hard on those negotiations to make sure they get as much as they can without killing the deal, of course. And then we kind of push that. So then we know, all right, this is where we're looking. This is what it's going to come out to. And this is how much you're actually going to receive if we go ahead with this sale. And then they normally either go, yes, I want to stay with it and I want to take that money. Or they're like, no, just let this thing go and throw cash to me as much as possible and let someone else run.
Now, it can also be very critical early on in the stages of conversations with a potential buyer. Should they be implementing some of these other tax strategies, such as this business trust, a deferred sales trust, or some of these other trust strategies, could be charitable remainder trust, what have you, that's brought into the conversation when needed. I mean, the buyer doesn't always need to know your tax ramification unless you're negotiating heavy on price. Sometimes a seller is willing to take a little bit less, acknowledging that they're going to have a more favorable tax outcome, but you don't know that unless you've brought these specialists in early on and they're able to figure out what you're able to roll over, what you're able to defer, what you're able to get as an exemption or other, charitable deduction if that's one of the strategies being implemented.
Yeah,
so
it doesn't make sense to go to a C Corp at the very end.
Right. So a lot of interesting strategies that could be accomplished depending on the client's need and outcome, which is why you bring in those experts. You talk to your advisors, you find out what other advisors need to be at the table if needed to back up to take everyone to the next level, so that in this perhaps sometimes largest transaction of somebody's life, you have the most favorable outcome.
And that's where we step into, we kind of act as CFO of the family office at that point, because there's so many different things that happen in and around the sale or the removal of the business owner. They have more money than what they used to. And so we try and structure it in a way to be able to then get a network of advisors that come in, what's the word I'm looking for? Give them advice on what they should potentially do with that money instead of going out and investing in all these other businesses that they may not know anything about. Like I've seen people blow through millions of dollars because they're like, yeah, I'm going to go put 50,000 on this business. I'm going to go put 100,000 in this business. And then there's all these people out there with more of a dream than an actual business. And so then we're starting to be able to advise them, look at pro formas, understand what's going on. And then realistically, we become the CFO of their life rather than just the CFO of the business, because at that point, they're intrinsically tied together because they're investing in so many different things and they're putting money in so many different areas. We should be encouraging and working with these people to increase net worth for the long run, because that's where, one, we're going to benefit because like there's AUM, there's money that we're getting for monthly retainers, there's tax planning, there's taxes, there's bookkeeping for all of the different businesses that they're part of. And then you're able to really start to generate what net wealth, like worth within your own company, but then we're able to take these people to the next level. And I always like to say to my guys, like for future generations, not just the one that we're in now.
So the CFO of a company, sometimes if it's just an in-house CFO, that's all they're worried about is the company and the shareholders. But your CFO services are quite a bit different from what I gather, in the sense that from what you just said, you go from the company CFO to family office type CFO, which includes their personal life or family CFO type services. Yep. And it's a mix or I wouldn't call it a mix necessarily, a coordination of those efforts to provide an overall best outcome for the owner.
Yes, because if they've got 100 properties, there's 100 set of books. There's 100 different things that we need to start looking at. There's net worth calculations. There's cash flow. What are we going to do with the additional cash flow? Where are we going to put it? Then we start getting into different areas and we're able to then expand our reach, because I don't know how many business owners I've worked with to get them where they've got so much cash and then they're very much like, hey, I'm going to go and do all these other things. And then we're kept in the dark from a tax planning perspective. And at the end of the year, when we're doing that tax prep, it's like, holy, where did all this come from? We haven't done a set of books. We don't know what's going on. And then we're having to try and scramble last minute. Well, the next piece in that puzzle is we start looking at everything that they're doing, not just one business.
Very nice. Well, Aaron, we've talked about a lot of different strategies today, and it's been kind of fun and exciting. I think we're asking, well, I've got a few comments here from some people. And maybe they're not the most patient individuals, but that's okay. That's okay, because we want to adhere to what people want, right? And they're asking for some real life examples. So let's go ahead and talk about some clients without using their name. Let's redact that information, but let's throw out some real life examples. I'll go first. I'll talk about a client, and my trajectory is short, meaning I get brought in for various immediate things that happen, right? And then if you wouldn't mind talking about a client that the trajectory is a little bit long and you're taking them from one point to the next, typically a longer distance, right? So very quickly, we had an amazing individual. I'm going to talk about two clients real fast. One individual who worked for Google and, 11, 12 years ago, invested $50,000, just put $50,000. Google's a good job, right? Put $50,000 into Bitcoin and then kind of looked at it years later and, well, it went to $50 million. She decided she didn't need to work for Google anymore.
Okay.
And not only did she not need to work for Google, but she's more than happy, or maybe not more than happy, but okay and willing. She's understanding of tax and tax ramifications. But she paid a consultant to kind of scour the globe for U.S. tax strategies, specifically for California tax too, what she could do to help mitigate the tax ramifications. And interestingly enough, she found us. And we were able to help her implement a variety of strategies, one being kind of the pinnacle or the keystone strategy that allowed her to sell out of some of her Bitcoin holdings, defer all of those taxes, which then allows her to offset them with future strategies. And having that almost be too good to be true for her, it took her a little while, but she, accepted it and believed that, wow, she doesn't have to pay taxes today. So much so that she can use this money that is kind of like earmarked for taxes in the future. She can use it to help build her net worth now, and not only build her own net worth, but help out a childhood friend with their business with funds that she didn't believe she was going to have because she thought she had to pay taxes on that portion today. Now, she was able to accomplish various things with that. Not only was she able to defer the recognition of this transaction to the future, she was able to also implement additional strategies to offset that later on. But in the meantime, invest and diversify her assets in things that she didn't believe that she'd have the excess cash to do, such as help out a friend with her business. Wonderful case example of how this would have been the largest transaction of her life and the highest taxable transaction ever. She was able to, I won't just say kick the can down the road, but take control over the timing of the transaction so that she can implement other investment opportunities that might provide an offset to what would have otherwise been taxed this year. So she was able to maximize not only the cash flow, but the tax flow, and take control over her finances, take control away from the government over the timing of when to incur that income. So there's that client. And since we brought up Bitcoin, where is Bitcoin today? Oh my goodness, it's almost at like, I won't call it an all-time low, but it's a really big dip, right?
Yep.
So who's making money in Bitcoin today? We've got some clients who are farming Bitcoin. Now, if you're going to be buying it, right now is a great time to buy, right? Because everything's down, it's discounted. It might go down further. Who knows? Nobody has a crystal ball. But if you're generating it, your cost is already there. I mean, everything that you're generating is going towards the future. Now, we also have some other clients who provide the electrical infrastructure for data centers and the electrical infrastructure for people who are mining crypto. And so depending on the timing of things, you may want to be in an industry, you might want to be benefiting from what that industry sells, or you might want to produce what that industry produces. And a lot of these are strategic high-level planning opportunities from a CFO standpoint, as well as a tax planning standpoint. And at the end of the day, I love this mentality, this methodology that Aaron teaches about profit first, all right? Just because everybody else who held on to their positions in Bitcoin when it was super high, now it might go back, right? And that's okay. But individuals right now who are buying in, dollar cost averaging or however they're buying in, or those individuals who are mining the crypto and who are generating it, even though it's coming out at a very low dollar right now, it has everywhere up to climb, which is very exciting. So 2 different clients, very different scenarios, one that just bought in and one that is building.
Yep. Okay. So I've got a client who's been with me, we're going on 4 years. And I've taken this client from, he was at $10,000 a month with a set of books that was needing a lot of work. So we had massive amounts of negative equity. We had loans out the wazoo, basically, and we were in a really, really bad position. And so he couldn't even get a home loan to be able to live. He was renting, he has kids, and we were just taking enough money to skirt by. So we came in and we implemented profit first, because I'm sure everyone's seen here that business owners at the very beginning like to spend too much. And then we really need to focus on profitability as the first step. So we focused on profitability, and we ended up scaling the business in that first year to $20,000, which isn't a lot. But we had enough money to start making key hires and enough spend to be able to go out and start doing Facebook ads, YouTube ads, all of those types of things. So we were managing that while still ensuring he had enough money and ensuring that we could put him on a correct salary, which was a reasonable compensation, which was about 60 grand at the time, to lower his self-employment taxes. The very next year with the marketing person, we were able to generate, by the end of the year, was about $450,000 in monthly recurring revenue. And so then the next year, which is this year, we're able to really start to grow that business. Now, we were at $5 million of last year. And so we were able to extract him from the business owner by making that marketing person the CEO. We were through that whole thing, taking out key employees and making sure that there was redundancies, making sure that he could be redundant, and the CEO always has those necessary people in place so that the CEO, if he goes out for a couple of months, he can. But what we were able to do is scale that. So this year we're looking at about 20 million. And so now what we're able to do, we got in the home, we're looking at other homes that we're able to start to buy to then, because now that he's focusing on real estate as his primary business, we're able to use the real estate to offset his gains within the company that's now making massive amounts of money. But we're also able to do the 831B, which we're going to do large amounts into that. We're going to be starting to get into oil and gas to increase his net worth. And then we're going to invest in more properties over the next 2 years and really build his portfolio to use that depreciation with cost segregations to really dial in and get as much tax savings as possible. Now, Jake has the ability to take loans potentially against the cash in the bank to be able to do the oil and gas. So there's a lot of different strategies there that we can use for someone with this high net worth. Now, we've got another one who's a cybersecurity company. Again, we took him from zero. Now he's at $300,000 a month. But we're able to then do captive. We're doing the strategy where we have equity holders that aren't actually equity holders because he wants to sell this thing for 50 million. And by the end of next month, we're going to have him withdrawn from the business. He's going to basically act as CEO. He's got other people running it. We've got those redundancies in place, but his net worth now has gone basically from zero. And we're not huge with him because he's a smaller company, but he's going to be at about $500,000 net worth after all his loans and everything else, because we're getting into real estate as well. And then we still have captives, oil and gases, and those types of things to increase where he's going. And then we're looking at other businesses. We're going on an M&A round where we're going to purchase 5 to 6 other companies and then really start doing those negotiations where we've got one that we should close within the next 2 weeks. And then we've got one that's going to happen within the next, probably, I would say 6 to 8 weeks. And then we're able to start doing these types of things and then tie different people in. Because, when you buy companies that are less than $1 million, you're buying the people in the company, not necessarily the company. And then we tie them back to that golden handcuff structure.
So can I summarize a little bit? My goodness, that was a lot, and that was really good. You use their mainstay business that you didn't even mention what industry then, and that's okay. But their mainstay business to build first a cash-centric business, and then real estate. And then you talked about making the real estate even more efficient from a tax perspective with cost segregation, all of that stuff. But it's another asset that is appreciating while providing tax benefits. And then you talked about oil and gas. And then you mentioned that they don't even have to use their own assets to invest in oil and gas, but they're going to be getting the royalties from other people's money into the oil and gas. And I think I missed one, but you talked about one other asset as well, that all of these assets that's increasing this client's net worth all came because of helping them be more profitable within their own business, not just having a spending plan like buying cars, right? But investing and building these other assets that actually give back to them, where a car, value goes down once you drive it off the lot. But like all of these other assets are providing income and revenue streams or appreciation, as well as tax benefits.
Yep. And 831B, because then we can take the real estate as well and put that into the 831B for cash flow purposes. So we can take 10% of the revenue from that. And we can go and do all of these other things where basically they don't have taxes anymore once they're withdrawn, as long as we continue to use real estate and as long as they're spending 75% of their time in real estate and those types of things. So just getting them out of the day-to-day opens us up to such a large amount of strategies and things we can do to appreciate their wealth and then be tax advantageous.
Well, very good. Well, Aaron, we are coming up on the last 5 minutes of today. And we've had a number of different questions. I believe we've answered most of them. Some of them are very similar, so we didn't go one by one, but we've answered the bulk majority of the questions. Anybody here on the Zoom panel, because we're also in Facebook and we're getting questions from both places. If anybody has one last final questions before we talk about how people can reach us and how they can get to know more and everything else, if anybody has a final question, please feel free to raise your hand, let us know, and we can go from there. We can give attention to one more question. We have one more question. It came in. It's the first one, Aaron.
Let me look.
It was just, how do we reach you?
Oh, okay. Yeah, you can go to bennettfinancials.com to get in touch with us. We do partner with other CPA firms that don't necessarily want to do CFO services and do specialize in tax planning. So we do work with a lot of other people. And then, bennettfinancials.com is the best place to get us.
All right. You can reach out to me and my team. We have a website called strategictaxsolutions.com. We also do a Friday webinar with Brett Swartz over the Deferred Sales Trust specifically. We have an 800 number, 1-800-773-1848. We also are getting a little more active on Instagram and social media. So feel free to watch for the upcoming advice, tips, and tricks, as well as things that you should be watching with current legislation and what's on the forefront of the economy. All right, everyone. Thanks again for participating. Thanks for coming. Thanks for your questions. And feel free to send us more questions for the following week. We'll be here the same time, the same place next week. And glad that we had you here today.
Thanks, Jack.
Thank you, Aaron.
All right,
Bye-bye.